Good morning. Time now, a few minutes after 8 o'clock in the morning in Tokyo, Friday, October 22nd, 2021. Welcome to another edition of the World Bank Group morning seminar organized by the World Bank Tokyo office. My name is Koichi Omori. I am Senior External Affairs Officer of the World Bank based in Tokyo. We organize morning seminars almost every week, introduce latest report presented by the World Bank Group economists and specialists. Twice a year in April and October, the World Bank's Prospect Group publishes Commodity Market Outlook, monitoring the price data of 46 commodities and compiling price forecasts along with historical data. October 2021 edition was released on October 21st, today in Washington time. In fact, it was released just 9 hours ago. Connecting from Washington, we have a pleasure of having John Buffett, a senior agriculture economist in the Prospect Group. John is the lead author of the Commodity Market Outlook and the long-time technical leader in terms of the commodity price data and analysis at the World Bank. John, good evening to you. How are you?
Good evening, Koichi, and the rest of the attendees of the seminar. I'm fine, and thank you for inviting me. And let me also thank you because it's the first presentation I'm doing for the commodities market outlook. So it's an honor for me to be able to present that to the Japanese audience.
Great, John. Thank you very much for being with us on the day of the launch of the report and giving the first presentation to the stakeholders in Japan, at the morning seminar. For next 30, 40 minutes, probably 40, 50 minutes, we'll listen to John sharing the main findings of the report. Following his presentation, I'll read your question asking John to respond. If you did not have opportunities to send your question in advance, please send a question using online form posted on the announcement page for this seminar on our website, or post directly your question on the chat section on the YouTube screen. I'll read your question asking John to respond after his presentation. With that, I would like to ask John to come in to start your presentation. John, over to you.
Thanks, Koichi, again for giving me the opportunity to present the commodities markets outlook. Again, thanks the audience for joining it. And I hope sometime sooner rather than later I will be able to present our report in person in Tokyo. Let me start by giving you the outline of my presentation today, which consists basically of three parts. At the beginning, I'm gonna summarize first the key takeaways of the commodity markets outlook. Then I'm gonna just scratch the surface of what the global growth outlook looks like today. I'm gonna give you a broad sort of general sense of what the commodity price trends look like. And then I'm gonna delve deeper into commodity markets, market developments and outlook, starting with energy, metals, agriculture. Then I'm gonna elaborate a bit on the fertilizer market, which has been very volatile market recently. And at the end, time permitting, I'm gonna elaborate on some risks surrounding the outlook. Just to give you an idea of the key takeaways of from the report, crude oil prices have really increased quite a bit. We project them to average $70 this year, $74 next year, and then probably decline gradually, but not a lot, very small. We have interesting developments in natural gas and coal prices, which have reached all-time high recently. That has a lot of implications for other markets, including electricity markets and fertilizer markets. Then in terms of agricultural prices, we expect them to stabilize in 2022. We project them to increase about 22% this year. And lastly, metal prices, we expect them to increase about 50% this year. And we are projecting a slight, about 5% decline in 2022. So those are pretty much the prices as we expect them to unfold this year and next year. Now, what caused the recent commodity price movements? What are the key forces behind them? On the demand side, we have stronger than expected demand growth during the sort of the recent part of the pandemic period, and that is especially true for industrial commodities, including energy and metals. We had a number of adverse weather conditions, and in the past, as we all know, adverse weather conditions was a characteristic that would cause quite a bit of volatility in agricultural markets. That surprisingly, recently, adverse weather conditions have not affected as much agricultural prices, but they have affected somewhat, but they had a huge effect on energy prices, and to a lesser extent in metal prices. That's one of the important developments that have been unfolding in the past 6 months or so. And in terms of causes of price movements, we also had some various supply chain constraints, which earlier we thought those are COVID-related constraints. In our earlier report, in the April of this year report we presented 6 months ago, our assessment was that those constraints will probably start subsiding and maybe going away at the end of this year or at the latest the first quarter of next year. The assessment now has changed quite a bit. Yes, our assessment now is that those supply constraints are going to persist throughout 2022, the entire next year. And the expectation that is it's only at the end of next year when the COVID-19 related supply issues and supply chain issues are going to sort of go away, not disappear, but they're not going to be a major determinant influencing commodity markets. What is at stake? High prices could fuel inflation. We have seen that because we have high prices across the board, not just in one segment. We have high prices in agricultural markets, in energy markets, fertilizer markets, metals, etc. And when you have an overall sort of synchronized increase commodity price across the board, and the commodity prices that have increased in the order, I would say 50%, then there have been worries about inflation. There have been worries about whether those high prices could slow down growth in, especially in energy importing emerging market and developing economies. We have issues with food insecurity and food price inflation in low-income countries. So the recent commodity price movements, that there are quite a bit high stakes here in terms of global both growth and inflationary impact. And in the longer term, the recent commodity price movements highlight the challenges that the global economy and all countries face in transition to a zero carbon economy. Now, what are the risks as we move forward? Of course, we have adverse weather, which has affected pretty much all commodity markets, especially energy markets. We'll see if things get better next year. Certainly, we expect quite a bit of volatility this winter, especially on the energy side. We have, as I said, continuation of supply constraints, which we expect them to sort of last throughout the entire next year. And lastly, the biggest risk, or one of the risks, is if we have new outbreaks of COVID-19. We have seen that the latest Delta outbreak has caused quite a bit of turmoil in some countries. Let me start with the global growth. This slide shows the global growth history and forecast. Those are the ones that were published by the World Bank back in June, the June edition of the Global Economic Prospects. So they are kind of 4 months old global growth forecast. We expect rather growth to average across the world 3.5% this year and increase to 5.6% in 2021 before it goes down to 4.3 in 2022. Now, that was the thinking back in June. In between June and now, the global growth assessment, again, based on estimates by other international organizations and investment agencies and other national agencies, I think the global growth, our assessment is that has remained pretty much the same as it was back in June. at around 3.5. Perhaps it's going to go a bit higher, 3.6. Some forecast currently at 3.7, but I would say 3.6 is probably the most reasonable number that the current thinking is kind of assessing the growth for next year. I'm sorry, for this year. Now, there's an issue, however. The composition of growth is going to change a bit in the sense that we expect smaller growth for next year, especially not especially smaller growth for the advanced economies, probably less than the 5.4% that we expected in our June forecast. And we see also we're gonna have a much higher growth in emerging market and developing economies. In other words, although the average growth remains pretty much the same for this and perhaps for next year or a bit higher, as I said, there's a shift of growth from lower to advanced economies and higher to emerging market and developing economies. So that's one element of growth. Now, there's another shift that takes place, or expected rather to take place, within emerging markets and developing economies. It's not surprising. It relates very well with the discussion we're going to have later in the report, or we have rather in the report in the commodity markets, in the sense that we are going to see also a shift of growth from commodity importing countries to commodity exporting countries. So that's not surprising because we have seen this huge run up in commodity price. So to summarize, global growth, not much difference between what we assessed in June and what we see now. We're going to see a shift from advanced economies to emerging market developing economies, rebalancing, so to speak, and then we're going to see another shift from commodity importing countries to commodity exporting countries, not surprisingly because of the high commodity prices. Now, where do we stand in terms of commodity prices? Following the sort of long period of stability in between 2015 and right before the pandemic, again, prices across the board, agriculture, metals, and energy were quite stable. Then we had declines in the early stage of the pandemic and then the recovery post-pandemic. Most commodity prices have reached highs that we experienced back in 2011, and in fact, some commodity prices have exceeded those levels. Now, in terms of the individual indices, the specific indices, we've seen a pretty much continuous increase in energy prices from the lows we experienced of April of last year. But we see a decline in agricultural prices. We've seen a decline in agricultural prices recently, and the stability, I would say, in metal prices. So let me start now by getting deeper, delving into the energy markets. And what we see here is the oil price to the left. I always like, or at least I used to like, to separate the last decade sort of history of the oil prices into two periods, the one before the collapse of 2014 and the one after the collapse of 2014. And we see a nice average that took place before the collapse of $104 per barrel, before the collapse of 2014. Now, after the collapse, although we have a 55% average, the $55 average, we have seen that the recently oil prices have increased quite a bit, and they have reached levels not seen since the collapse of 2014. So I don't know, I don't think we are heading back to the $110 per barrel or to $100+ per barrel we saw back prior to the collapse of 2014, but certainly we are very close to that levels. Recently, prices reached the average, the rollback average that we follow reached $8 per barrel. Now, even more interesting developments take place in the coal and natural gas prices. We've seen some, of course, the declines that took place during the pandemic, and the huge increase that took place during the past 6 to 8 months in the prices of coal and natural gas. Now, what are the forces behind those price increase that we have seen in energy? Let me first, before I do so, let me also just give you a longer term picture oil prices, 50-year data of real oil prices, and we see that the average over the 50 years is $56 per barrel. Now, as I said earlier, we are about $80 plus, so we're much higher than the historical average, but I wouldn't say that we are way higher than the historical average of 56%, just to keep the history in perspective. Now, let me go deeper now into the supply and demand forces that sort of shape the oil price developments. And to the left, we see the global oil supply growth. What we do is we compare how much supply takes place in the oil market, but we compare that to the January 2020, which was pretty much right before the month before the pandemic. And what we see is that we have kind of a decline in supplies. We have declined supplies across all three major sort of groups of oil suppliers, one of which is the core OPEC countries. You see the red portion of the line of the bars here, and then we have the other countries that have joined OPEC, the so-called OPEC plus countries that have also joined, and they introduced, they went along and they introduced cuts which were decided back in April of May of last year. And we also we have other countries, the blue bar, that they include all non-OPEC plus countries. And we see that we have declines across the board, not just OPEC or OPEC plus countries. So the key takeaway here is that on the one hand, we have OPEC plus that they have sort of decided to keep supplies constrained. And although there is some capacity there, spare capacity, this spare capacity is not fully utilized. So there's a strong cohesion, a surprisingly strong cohesion among OPEC plus countries. But we also see other countries, as I said, that sort of lower supplies. To the right, we see the chart of oil production in the United States, which shows oil production along the lines and also the rig count. And we see that oil production, the rig count, when we take it a 3-month moving average, has been declining compared to the pre-pandemic levels. Why this happened? And in fact, that was the second, so to speak, not expected outcome from the oil market. The first, of course, was the cohesion among OPEC plus countries. And the second is that we did not see a strong supply response as we expected and as we saw in earlier price spikes, oil price spikes from the United States, from the shale oil industry of the United States. And there's at least 2 or 3 reasons as to why we do not see that supply response. One important reason is that a number of operations, shale oil operations in the United States, moved hands from smaller operators to big companies. Large oil companies are more interested in delivering returns to shareholders rather than sort of going after supply response. And those large companies, so-called majors, have not really increased production. In fact, some of them have restrained, have sort of dropped production. So that's one reason as to why we have not seen much supply response from the oil industry, shale oil industry in the US. And the second reason is that we have various constraints that have affected the input industries. So expanding supply sometimes it's not possible because of the various supply chain constraints. And the third reason is that we have high input costs, especially labor costs. So we have supply constraints on the input side, higher input costs, especially wages, and the fact that major oil companies they try to, if I can put it this way, please shareholders rather than increase output. And that's why we have not seen much supply response in the US. Let me now move to the demand side and see that in the chart to the left, we see that global demand growth, we separated by OECD, China, and non-OECD, of course, excluding China countries. And we see that pretty much across all 3 segments of the market, we see a huge supply response. In fact, when we compare in China, we compare the pre-pandemic period, which we consider this to be the fourth quarter of 2019, we see that recently, I mean, the current quarter, China has exceeded the pre-pandemic levels, and non-OECD countries, when we exclude China, has reached pre-pandemic levels. This is the yellow line. It's only OECD countries that kind of experienced quite a bit of an increase, but it's expected to stabilize for the next few quarters. By the way, the shaded area denotes forecasts, and the non-shaded area to the left denotes actual data. Now, strong demand, restrained from the OPEC plus side, not much supply response from the US shale industry gives us the picture that we see to the right. And what we see to the right is that the OECD oil inventories have been going down this year from January until August, which is the last data point. And when we compare that to the average, which is the dotted yellow line, we see that now we're much, much longer than the average of the 5-year average, and we are reaching sort of levels that are very sort of low by historical average with the shaded area. So to summarize developments in the oil market, strong demand post-pandemic, rather we are still in the pandemic period, strong demand by virtually all parts of the world, restrained supplies by OPEC plus, not much supply response from the US shale oil industry has pushed inventory levels to not record low levels, but low levels, and that has generated an environment of high sort of oil prices. So those were developments in the oil market, but what we have now is interesting developments in the other energy markets. And as I said earlier, weather has played a big role in other especially in coal production, natural gas production. That's a very interesting development, because what we saw is that we had on the one hand a huge demand, as I said earlier, because of the recovery. But then we had adverse weather conditions. We had the heat waves, which increased the demand for cooling services. We had some drought in various countries, especially in South America, which lowered the level of dams for hydroelectric production, and that created a gap between what was the demand for electricity and what was the supply for electricity. And that's very interesting here, because we see the bad weather or adverse weather giving a huge boost to demand from electricity point of view, but also adversely affecting supply conditions. To the left, we see the percent of total US electricity generation in total energy consumption, and we see that we have a huge decline beginning of earlier this year, and we expect, according to the EIA, to the Energy Information Administration of the United States, this hydroelectricity supply is expected to decline even further throughout this year before it picks up next year if weather conditions are good. And to the right, I give you another example of natural gas inventories in Europe. And what we see there, it's the red line that inventories, which typically build up during the summer period in order to have supplies for the winter, they have been building up at rates that are much, much lower than earlier years, and they are even below the range, the five-year average that we have experienced throughout the past 5 years. So what we see is that not only we have some tight supplies and strong demand from the oil market, but we also have tight supplies and strong demand, part of which is weather related in the other energy markets. And that has created this cocktail, so to speak, this volatile cocktail that we've seen the energy price index virtually, spiking or skyrocketing, if I should put it in more proper terms. Let me move now to the to the metal markets. Metal markets, of course, metal prices rather have, again, they have increased a lot during the pandemic. Most of it was driven by demand by China. And to the left, I'm comparing the metal markets index with the global manufacturing, purchasing manager index, and we see that there's very close correlation between the two indices. When things deteriorating, the situation deteriorating back in the early stage of the pandemic, we saw the metal prices declining, but in the moment things, the thinking about the global economy changed, or the manufacturing side of the global economy changed, we saw metal prices increasing. Now, to the right, we separate our metal price index, the so-called base metal prices, which are the refined metals, including aluminum, copper, zinc, etc., versus iron ore, which is an ore. It's before the sort of refining process, and we have a divergence in those prices in the past few months, and that's because there was not much demand for steel manufacturing in China. That's why we saw this sort of nosedive in iron ore prices. We also saw some supply constraints in the manufacturing or the smelting sort of facilities for the refining metals, and that also was one of the key reasons, in addition to the recovery in the economy, why we saw those refined metals, or so-called base metals prices going up. Now, just to elaborate a bit more in metal prices, as I said, China is a key force behind the metal, develops the metal markets. To the left chart, we see how China today is dominating the world metal consumption, something from the order of 5% 25 years ago to 55% today. Now, let me add kind of elaborate a bit on the China's demand on metals. I don't want this to sort of be misunderstood. So China does account, as I said, for 55% of metal demand, but not all that demand stays in China, because China has been sort of the manufacturing hub for the world for the last few years, and a lot of metals go to China, and they are either sort of processed and they go out of China's exports as final goods, or metals go to China. China builds sort of manufacturing facilities in order to produce other goods that go out of China's exports. So in fact, we see that, yes, it is the case that metal demand has been dominated by China, and only part of it stays in China. The remaining part goes back to the rest of the world. Now, in terms of metal consumption, the chart to the right, we see that the sort of negative growth that took place during the early stage of the pandemic, especially by OECD and other non-OECD countries. In China, we only had one month of decline. That was back in April 2020. Then Chinese demand kept strong throughout the pandemic. But what we see recently in terms of metal demand, we see that although China has not grown as much in terms of metal demand, that's of course explained by the fact that it had already grown last year. We see other countries, especially other non-OECD countries, which had experienced declining growth, negative growth last year, to pick up so reverse that growth. And that's of course is one of, as I said earlier, one of the main reasons that we see high prices in metals. Just a bit of precious metals developments before I move to agriculture. To the left, we see prices of gold and price of platinum, two of the three most important metals. Not much surprise in gold. We see a huge run-up during the early stages of the pandemic. Not surprising, because we had bad news from the global economy, and when the news are bad, and the interest rate environment is low, gold prices increase. When the reverse is the case, gold prices go down. What I find more interesting is the movements in the platinum prices. Now, platinum, although we classify it as a precious metal, it's also an industrial commodity, and I believe as much as 50% of platinum goes to car manufacturing, for the for the engine for environmental purposes. So what we saw is that as the pandemic, as the car demand recovered in the early stages of the pandemic, platinum prices went up. But then what we see the last 6 months when we had a reduction in car manufacturing because of the microchip shortage, not much cars are produced, or at least we do not have car production that we had before. We also see demand for platinum goes down. That's why we see some downward pressure on the price of platinum. So the price of platinum downward pressure that we see to the very right of the left chart reflects the fact that there are some headwinds in the auto manufacturing industry. And just to summarize, to close with the precious metals price developments, what we see in the chart on the right, I have taken 10, 11 years worth of data, plotting the interest rate, which is the US 10-year Treasury bill inflation-adjusted security, versus the price of gold, and we clearly see the inverse correlation, the inverse movements between those two variables. When you have very low interest rates, investors prefer gold and other, of course, investments. When we are in a high interest rate environment, investors sort of get out, so to speak, of gold, and they prefer other investment assets, especially the ones that are related to the interest rates, such as the dollar. So that's not surprising. So in terms of, as we move forward, again, just to summarize, what's going to affect precious metals is interest rates, especially for gold, and auto manufacturing, especially for platinum. Let me move to agricultural prices and agricultural market development, because I found the agricultural market developments very, very fascinating during the past year and a half. Here I'm showing you the agricultural price index decomposed into 3 parts: the beverages part, the raw materials part, and the food part. Now, beverages is the 3 main beverages that we all know: coffee, tea, and cocoa. Raw materials are timber, consist of timber, cotton, and natural rubber. And of course, food is a very broad category, and it contains all major commodities, food commodities, grains and oil seeds, including wheat, maize, rice, soybeans, etc. What we see is a kind of relative stability of raw material prices that increased a little during after, let's say, April or May of last year, but they are quite stable. They have been quite stable now. Looking at beverages, we see the spike that has taken place throughout the last 2 quarters, and that is explained purely because of a frost that affected the Brazilian coffee production. It's estimated that may have reduced their crop by something in the order of between 10 and 15%, which is quite a bit, not quite a bit, it's quite a lot for the global market, because Brazil accounts for nearly 40% of the global I believe it accounts for 1/3 of the global coffee supplies. And we also had some issues in Vietnam. Again, Vietnam is the 2nd largest coffee producer, the world's 2nd largest coffee producer, which they had some supply issues and some lockdowns recently that also affect their coffee, which is the dominant producer for the Robusta market. Brazil accounts for most of the Arabica market, Arabica coffee. So that's why we see this spike in beverages. It's coffee-driven supply issues. Now, the most interesting developments in food markets, in food prices, where we saw this continuously, so to speak, increasing prices between April of last year until a few months ago. Prices of the 16 quarters in 16 months, 15 months were positive changes in food prices. So what happened in the global food commodity markets? Let me begin by trying to attempt to analyze what happened in the past few months, which explained the decline in food price, what we see to the very right of the chart. And this is a picture of the ongoing developments in the global food commodity markets. I have taken the 4 main commodity markets, which, by the way, account for probably more than half of the world calorific food production and consumption. This is wheat, rice, maize, the 3 main grains, and soybeans. What I'm showing here is the following. The red lines in those charts give us what is the estimates. In fact, it's real data, not estimates by now, it's real data of last season's crop, the crop that ended this summer, and those are the red lines. Now, the blue bars indicate the assessment, how this assessment, the assessment for this season's crop has evolved from May of this year up to October of this year, which is the latest data. So basically, the red bars tell us what happened recently, last period, and the red line rather, tells us what happened recently, compared to the blue lines, to the blue bars, which tells us how the assessment of the current season has evolved. And there are a couple of interesting developments here. The first development is that in 3 out of 4 crops, in the current season, we expect a higher production than the previous season. It's only wheat that the current production is expected to be lower. For the other 3 commodities, rice, maize, soybeans, we see that the last bar is higher than the red line. So this is one sort of development. The second development is that in those 3 commodities, that is rice, maize, and soybeans, what we have seen is that the past few months, there has been good news, better news for the season. The bars go higher rather than lower. And that pretty much explains why we have seen declining food prices in the past few months. But that's not the end of the story. The question is why we have seen higher prices throughout the past 1.5 years. Now, here I'm showing you, again, grains and edible oils, the recent sort of crop, the 2021-22 crop, which is the last bar, the bar to the right, and I'm comparing that with a longer-term crop developments, which is the red line again. Now, I'm comparing what happened this season or what is unfolding this season with respect to what has happened the past few seasons, it's the blue bars, versus what has happened in the past 30 years. And this is the average, the red lines indicate the average growth rate of grains and edible oils for the past 30 years. And as I showed you earlier, we see that in the last season, in this season, we're pretty much close to the average, which kind of explains the stability of the food markets recently. But what we also see is that the past few seasons, we had below average growth rates, which explains why we had this upward sort of movement in food prices. But again, the conditions were tight, that pushed prices up, but it's not the whole story. I mean, to complete the story, first we have to look at the historical developments. And the historical developments, which pretty much confirmed what I showed you earlier, is the following, that when we look at the stock-to-use ratio, which tells us sort of how supplies are compared to demand, the health, so to speak, of the global food market, that here we have taken all food commodities and we have aggregated into one index by weighting them calorific content. What we see is that this index has gone down from a high of 31% in 2017 to 27% now, which is a decline that explains the upward pressure on prices. However, when we compare the 27% now with the earlier history, we see that in 2006, for example, this was 17%. So now we are much, much higher in terms of supply than what we were back in 2006, which led to the 2007-2011 price spikes. So we have tight markets, supply markets, not as tight, but yet we have prices which are much, much higher than what the markets, the demand-supply markets would explain. And one has to look at input costs. Earlier in the presentation, when I talked about energy prices, you saw the chart which the spike in natural gas and coal prices. To the right in this chart, we see most of fertilizer prices spiking. We have seen changes in the order of a threefold increase or a 200% increase in at least some of the metrics that we use for the fertilizer prices. So we have a huge increase, a huge pressure from the input side. So that's another sort of explanation as to why we see higher food prices. And a third explanation is the fact that we have a recovery in biofuel prices, in biofuel production. That also puts some more pressure into food prices. It pushes them higher, which is what we see to the left. We had a reduction of 7% of biofuel production in 2020, but assessment for this season, for this year, is that pretty much the entire decline will be reversed, and we're going back to, in terms of biofuel production, back into 2019 levels. So that's one aspect. And the second aspect is that a lot of countries have made bold grant announcements of diverting more food into biofuel production simply because they want to meet zero emission targets by 2050. So to summarize, in global food markets, we have tight conditions, or rather we had tight conditions for the past few seasons. This season is fine. That combined with higher energy costs, higher fertilizer prices, and perhaps some pressure from diversion of food commodities, biofuels, have created this environment of high food prices. So this is our assessment in terms of food prices. Now, let me try to conclude the presentation by summarizing what are the risks to this outlook. On the energy side, we still have not seen yet supply response from the US shale oil industry for the reasons that we're expecting. This is a question mark. Perhaps we can see down the road. Still, we don't know. OPEC cohesion was a bit of a surprise to us. We thought that OPEC would, by cohesion I mean OPEC restricting supplies. It lasted, in our opinion, much longer than what we expected. So that's a second sort of risk, what's going to affect any oil markets down the road. We saw the big surprise in the weather, and especially in coal and natural gas markets, that create a lot of volatility of upward pressure. If weather continues, we have weather problems, that's going to keep coal and natural gas probably as high as they are at current levels. Now, on the downside risks, we have a demand weakening due to demand weakening due to COVID-19 outbreaks. We saw the Delta variant that affected some countries, but it was not the sort of lockdowns were not widespread enough to have a big impact, rather an impact in the energy markets. But in the longer term, we have the risk of, not the risk, we have the issue of energy transition, and that would mean less fossil fuel use and, of course, more use of renewable energy. So if that materializes, the energy transition proceeds, under any scenario, probably we're going to see downward pressure on energy prices. But again, that will depend on how this transition unfolds, whether any policy measures affect the demand side of the energy markets or the supply side of the energy markets. Because if they affect the demand side, we are going to see lower energy price, but if they affect the supply side, we may in fact see higher energy prices due to the transition. Now, when we look at metals, we have two sort of demand stories unfolding there. We have the China's real estate sector, which faces some headwinds recently. If that persists, then we're certainly going to see lower metal prices. On the other side, we have the US infrastructure spending in the United States. Again, this is an issue that is very complicated. In the United States, decisions are made through a multi-step process. You have the Congress to approve, then you have the other chambers of the executive to approve, then you have the president to sign before it starts, and then of course it's a private sector issue whether there will be an uptake in infrastructure spending. But by all indications, it looks like infrastructure spending is a priority for the current administration in the US, so we could see some increased demand coming from this country. And then in the longer term, we have the energy transition. By most accounts, metals is the so-called winner of the energy transition, especially metals such as copper and zinc, tin and aluminum. Most all metals are big winners because cars are getting, electric cars are heavier, especially the batteries. I mean, you have wind turbines, you have other types of new energy sources, and all of them are metal intensive. So as the energy transition progresses, we are likely to see higher demand, probably higher metal prices. Lastly, on agriculture, we had adverse weather earlier in the year that affected some of the crops, especially maize in North America and soybean in South America. And we have the emerging La Nina phenomenon, which see some news that as much as there is, I believe, a 90%, close to 87% probability that this winter is going to be a La Nina winter, but La Nina is not as does not affect as strongly the global commodity markets as El Nino, because it has mixed effects in the sense that it may have some harmful impact, negative impact on South America and the northern and the southern part of the United States, but it may have a beneficial impact in the northern part of the United States and in Canada and in other places of the world. So although it may have some localized positive and negative impacts, La Nina, we do not expect this to have a broadly big impact on agricultural markets. Of course, the big risk in agriculture, in my opinion, is higher input costs. Agriculture is an energy-intensive industry. Higher input prices we could see affecting food prices, and that's the surprising part. You may not have disruptions on the supply due to weather issues, etc. But as long as you have higher input costs, in order for producers to cover the costs, they have to increase prices. So the big risk in agriculture is higher input costs. And the question mark is how much of the biofuel announcements that various governments have made are going to translate to actually policy actions. Biofuels now account by an estimated 4% of global land. That is 4% of land allocated to food commodities goes for biofuels. If the announcements by the various governments materialize for the next 5 years, we can see an additional 2% being allocated to biofuel production. That's a big chunk of land going to biofuels. So that's also another risk, a kind of longer term risk that may affect agricultural price and food price in particular. I just want to end the presentation at this point. As Koichi said, as we said earlier, we just launched the report. We have plenty of material. We have the report, of course, in a PDF, which can be freely downloaded. We have commodity prices, detailed commodity prices, which include September. We have a blog which summarizes the report. We just launched it at the same time when we launched the report. And for the next 1 month or perhaps 2 months, we are gonna every week we are gonna be publishing one blog which is gonna cover in detail every segment of the agriculture of the commodity markets. The next one, I believe, is going to be next week. We are going to get deeper into the oil market, and we are also going to cover recent developments. And on the second working day, just to remind you, on the second working business day of each month, we publish our so-called pink sheet, which summarizes the price developments, the prices rather, in close to 70 commodity markets. Let me end my presentation here, hand it to Koichi, and I'll be more than happy to answer questions either directly now, or you can get in touch with me bilaterally and I can answer questions through email or even talking to you.
Great. Thank you, John, for giving us a snapshot of the very latest the commodity market outlook report, which was just released earlier today in Washington time. We received one question from the audience. Sasaki-san, thank you for your question sent during the seminar. And let me, yeah. The question is this: what will be the main impact and risks on the commodity prices derived from the continued delay of the vaccine rollout in developing countries, including Africa? John, you talked a little bit about demand weakening due to further outbreaks, but if you could add any further comment on this point, that'd be great. Thank you.
Thanks, Koshi. Just to understand what's going to be the effect on Africa, is that the question? Okay, yeah, that's a very good question. I'm glad you asked this. In fact, we do cover partly this issue in the report, where we look at some food security and some price inflation issues. And the big risk now with high commodity prices, high global commodity prices, is the big question. The question rather is how long it will take for the high global prices to be transmitted to domestic markets. Sometimes it takes time. It's not an immediate, so to speak, transmission. The transmission is not full. It's simply the fact that global prices increased, let's say, by 50% doesn't mean that domestic prices are going to increase by 50%. The transmission is less than full. But what's interesting now, and I would like to highlight, is the following. It's not only the high food prices that African economies and other low-income countries are facing now. It's the fact that they are facing high input costs, because to produce and to transport commodities, you need oil, you need natural gas, you need coal, and you need fertilizer to produce it. So domestic and of course high domestic food price inflation affects food security. We have seen during the pandemic, and especially this year, increased food insecurity in various countries, and especially low-income countries. So what we think that is the risk now is that we have a risk of the high food prices, world food prices, being transmitted to domestic food prices, especially for the food importing countries, but we also have the risk that the high energy prices, high fertilizer prices are going to impact domestic food production. It's just going to feed into food price inflation. And we also have the various supply side disruptions and supply chain disruptions that we thought are going to end this year, but in fact, by our best assessment, they are going to end probably by the end of next year. So we may also see local supply disruptions. So what I would like to highlight here is the following, that although global food prices have stabilized the last 6 months, that doesn't mean the end of their effects of domestic food prices. We may see quite a bit of inflationary pressures, and for countries which are commodity dependent, that can affect growth as well. So the bottom line is that there are a lot of risks in domestic low-income countries, despite the fact that we see stability in global agricultural prices.
Great, thank you very much. I have the questions sent from Professor Yoshino just a moment ago. So let me read his question. And I have also one question from my side.
Yeah.
Professor Yoshino's question, how much would these commodity price rise will push up the general inflation rate? The causes of commodity prices are coming from capital flows and real demand supply. Approximately how much % comes from financial flows? These are the questions from Professor Yoshino.
If I understand your question, how much of the food price increases are sort of are accounting for the price inflation? Is that the question?
Yes.
Yeah.
Yes.
Yeah. Okay, great. That depends on the country. In the low-income countries, households allocate as much as 50%, probably 70% of their budget to food commodities or to food in general. So in those cases, although I cannot give you a precise percentages, in those cases, I mean, we could see certainly a ratio of, let's say, 50% of commodity prices or half of the increase in commodity prices to be transmitted into food price inflation, simply because a lot of the income it goes to food price expenditures. A lot of the income of those low price income countries. Now, when we go to other emerging markets, developing economies, which on the higher end of the higher income end of the spectrum, there we do not see much of an effect. And again, I don't have numbers off the top of my head, but I would say the number there would be into the single digits. And if you move to high income countries like OECD countries, the percentage is much, much smaller, because what we see, the food price increase that we see in the supermarket, part of it depends because we have high sort of wheat and high soybean prices, but part of it also depends because we have high energy prices, high labor costs, high transportation costs, and a number of other issues. So it does not really reflect, so to speak, fully the large increase that, no, it reflects fully, but does not depend on the as much on the primary commodity prices as much as it depends on the other value addition that takes place into the high income countries. So if I could give a number, and again, that's a very rough number. This can range for a very few percentage points, let's say 2 to 3 in advanced economies, to as much as 50% in the low income, the very low income countries. So it's a huge range.
Thank you. One question from my side, and then I'll ask you to give us a final remarks, and then we wrap up the seminar. The slide 12, China dominates metal consumption. This is one of the slides that I keep enjoying when I listen to John, your presentation. Now, on the right side, metal consumption growth for the July 2021. We see really major expansion on other non-OECD countries, yellow component compared to the previous years. So would you please elaborate a little bit on what's going on there, and then I'll ask you to respond together with your final remarks.
Thanks, Rich. That's a good point. That's a fascinating chart, especially the one to the left, where China started from something 3 or 4% 20 years ago, 25 years ago. Now it's up to 55%. Now, in this chart, we have to bear in mind one technical detail, but those are percentage changes from the year before. So China did not have much of a decline the year before during the pandemic, and that's why we do not see much of an increase. On the other hand, the other countries had huge declines during the pandemic, and this so positive impact is simply reflects the fact that we had a huge decline earlier in the last year of the pandemic. So this, in a sense, is I wouldn't call it statistical artifact. I would call it a recovery of the non-OECD, excluding China countries, recovery to pre-pandemic period. So that's how I would kind of frame this. I don't think we should not explain it or describe it as interpret it as a fact that you have a kind of huge increase in demand. You have this to us show a recovery to pre-pandemic levels. That's what it is in this chart. Now, in terms of final remarks, what kind of we've been struggling, as I said, as we said in the bilateral sort of discussion earlier before we start the seminar, in this commodity markets outlook, we struggled a lot to put the story together, so to speak. And what came out? What are the key takeaway points? The first takeaway point is that how weather can affect markets beyond agriculture, because our thinking for most of us is that, okay, we have bad weather, that means we have a lower wheat crop, or we have a heat wave, lower soybean crop. That is our thinking. And what this showed is that weather can have huge effects across all commodity markets, not just agriculture. So that's one takeaway. The second takeaway, again, on the weather, is that it's very interesting that it affected both demand and supply of commodities, especially energy commodities, because you have a heat wave, you demand for more electricity to cool down your house, your car, or whatever, but this very same heat wave causes a drought and lowers the lakes that generate electricity from hydroelectric sources, or you don't have the wind blowing to generate wind power, etc. So it has two effects, on the demand side and on the supply side. That's what this period of that's what is one takeaway point. A third takeaway is the difficulties the world is going to be facing in the energy transition. The energy transition, if the volatility that we experienced the last 6 months continues, it's not going to be smooth. So policymakers have to rethink in this energy transition what's going to be the fuel that will take us from where we are now to where we should be in 2050. The current thinking or the recent thinking was that natural gas was going to be the transition sort of fuel that's going to take us from the fossil fuel to the renewable energy in this 30-year period. Increasingly, I see in the reports that perhaps nuclear power may also have to play a role there. And in fact, I would point you to a blog that our president, a brief that our president wrote with the head of the International Energy Agency that was published, I think, 6 or 7 days ago. It's in the public domain, where they addressed this issue of the energy transition. That's a very complex issue, and that the recent events, weather events, highlighted how difficult it's going to be. And they said that among all the sources, nuclear energy may play a role down the road. Of course, we all know that there's issues of safety issues, public acceptance issues, waste issues, etc. There's no question about those elements, but that's sort of another thing that I can see being discussed in the public domain. And lastly, the last point, my last takeaway was what is unfolding in food markets. This is from the risk perspective that although we see food markets being very calm now, and in fact, we've seen prices coming down the last 5 or 6 months, there may be huge risks for food importing countries for a number of reasons. First, because it takes time for the high food prices to be transmitted domestically, but we also have the issue of, as I said, input costs, which may push domestic food prices higher, and it's the question of the biofuels. I've seen a lot of ambitious targets, and again, in the past, governments have announced ambitious targets on biofuels. They have not followed up, but given the pressures on the energy transition, we don't know how this is going to unfold the next in the medium term. So those are my 3 or 4 takeaways from this round of our commodity markets outlook.
Thank you very much. With us this morning from Washington, John Buffett, Senior Agricultural Economist, Prospect Group in the World Bank. Thank you very much, John, for being with us, presenting the reports this morning. Really appreciate it. Thank you.
Thank you very much, Koichi. Let me also thank your office for putting it together, but I would also like to thank a lot of my colleagues, which are named in the report. I'm not going to take the time to name them now, that work really hard day and night during the weekends to put this report together. Again, special thanks to all of my colleagues.
Great, thank you. Okay, next week we will continue our journey through 6 regions featuring the latest edition of the Regional Economic Update. Our featured region next week will be South Asia. This will start at 8 a.m. Friday, October 29th in Japan Standard Time. Please check our website for details. Have a wonderful weekend. Once again, stay safe, stay healthy, and see you next week. Thank you very much.